Welcome back to Mike on Money. My name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management. And thank you for joining us again this week where we talk about everything financial. Today we continue our third part in our four-part series on cryptocurrencies. In part one, we talked about blockchain and what the characteristics of that are. Part two, we talked about Bitcoin specifically, as it is one of the largest parts or largest currency of the cryptos at nearly $1 trillion in value, more than half, or at one point, half the value of all the total crypto market out there. And today we're going to be talking about Ethereum and stable coins. So different types of cryptocurrencies, because they are different. They are meant to be used in different ways, and therefore investing in them is for different reasons. Before we jump into that, though, as always, these videos are for educational purposes only. Always seek the advice of a professional or do your own due diligence before applying any strategies to your portfolios to make sure that they fit into your strategy and your risk profiles. If you want more information on how investing into cryptos may or may not fit in what you're doing, reach out to us at mikeonmoney.com. You can find our email, our phone numbers, and you can access our calendar right there if you want to book an appointment to discuss how you might invest into it or how you might not want to, depending on your risk adversity, because they are very, very volatile, and you should have a very high risk tolerance if you're going to use them. So with that, let's jump into Ethereum and stablecoins. So Ethereum came later to the scene in 2015. We mentioned Bitcoin came out in 2008, and Ethereum was a rule-based cryptocurrency. So again, if you remember from the blockchain, how transactions are recorded and how ledgers are being kept for who owns what and where the coins exist, and every transaction that takes place. So Ethereum was built on a rules-based transaction. So basically, this transaction starts, but the next thing that's going to happen, once that trigger, that rule happens, the next part of the transaction happens automatically and automatically and automatically till all the rules have gone through. So no interference in the blockchain by a human has to take place as those rules are being fulfilled. And think about it as escrow. If you put money into escrow, as soon as the underlying rule, the underlying goal of escrow is completed, those funds then get released from the escrow automatically to the individual that it should go to. Or if the rule does not get completed within the time frame, it reverts back to the original depositor. So when you think about financial transactions, that's a big time and money saver, because a lot of financial transactions are rule-based, and you can have as many rules as you want. So Ethereum was designed to be on the blockchain, but to do more complicated transactions that are very rule-based. And so they follow all these things and it gets completed. And we're actually seeing that become way, way more popular in the recent year of 2020, in growing from about 1 billion to over 40 billion, whereas Ethereum is now the second largest cryptocurrency in total market capital, just only ahead by Bitcoin. And that growth really grew through 2020. Prior to that, there wasn't a lot of that happening, but of course 2020 pushed all kinds of companies, all kinds of industries to online transactions, to e-commerce, and this led to Ethereum becoming used for everything from loans to transactions. Anything that there's a set of rules that as soon as that's approved, it moves on, it moves on, it moves on. So it's gained a lot of favor, and of course the valuation of Ethereum has gone up dramatically through 2020. And is expected to continue to grow as more and more applications and more financial institutions find ways to use Ethereum for transactions and save money in the process, right? So faster, easier, and less human intervention as those things go through. So very different from Bitcoin, because remember we talked about Bitcoin was a value retention type of currency, not great for transactions, especially small transactions. Ethereum, bit different, it saves money, cheaper, not necessarily a cheap everyday transaction, but the more complicated and rules-based or steps in the transaction, the cheaper and cheaper Ethereum becomes to do that transaction. So that's important to understand those two differences, because when you go to invest into them, why are you investing in it? Are you invested into growth in use of a cryptocurrency like Ethereum's expanded dramatically as to where it's being used and how it's being used, versus Bitcoin, which is kind of that retained value. Remember, we compared it to gold, so a little bit different. So what are you looking for? You're looking for growth in market, or you're looking for scarcity and retained value. So those are two different investments and two different characteristics, and their volatility, of course, will change over time, especially as those currencies are adopted more and more. Now, there are a lot of other types of currencies. I'm not going to dive into them all. There's hundreds and hundreds of small ones. I'm not going to discuss the Dogecoin. You'll have to do that one on your own, or call me if you want to laugh. But anyway, there are lots of other ones, but that's the second biggest one is Ethereum. I am going to talk about stablecoin. So stablecoin is another type of crypto. Now, this is very different than Bitcoin and Ethereum in the sense that stablecoin, as its name implies, is value is much more stable. It's actually pegged to a fiat currency. So most commonly it's pegged to the US dollar in value. So it'll fluctuate with the US dollar, but that's it. Now these coins have gained a lot of attention and more popularity again in the last year or two for international businesses paying for services or paying for goods. So if you think about it, if you go through the traditional banking sector and I have to pay a company in Germany, there's a lot involved in that transaction, right? Different banks talking, it can take up to a week or so. Believe it or not, when we do international transactions or move money internationally, it's not that simple. There's a lot of hurdles to kind of jump through. But if you think about stablecoin, where I can peg it to say the US dollar or the euro, and I want to make a payment to that currency, or sorry, that company in Germany, I can just transact over the blockchain instantly a transaction of stablecoin to them, and then they can convert it to euro or US dollar or what are the underlying currency that they want to use or that they use within their accounting process. And all of a sudden you get that transaction happens immediately, and you get confirmation across the blockchain that it's happened and it's done. So those are gaining a lot more popularity through, especially the last year, when there's been so much more e-commerce happening or electronic trade happening around the world. So as you can see, we talked about Bitcoin, very different from Ethereum, and stablecoin even more different. So when you're looking at a particular type of crypto that you want to invest into, you really have to think to yourself, what are its characteristics? Why would I buy that? And what do I want it to do in the portfolio? So with that, I'm going to move to part 4, where we're going to talk about how to invest and the risk of those different ways to invest in, and also the characteristics of those different investment vehicles. So remember, go to michaelmoney.com if you're looking for more information, and we'll talk soon.